that estate tax down to zero. But of course, they didn't anticipate people would be dying at the age that they died. They didn't anticipate the situations that occurred. So we do the life insurance trust, and we get into that, the life insurance proceeds. Now say that your estate, even after the life insurance is removed, is over $600,000 or say $700,000 or $1 million or whatever the amount is upon your death. What do we do with the balance of that? Well, if we have a husband and wife situation, we can double that exemption. We can take the $600,000 or now $650,000 and double that. What we do is we do what's called an AB trust. We take the living trust, and upon the death of the first person to die, we split the trust into two. We have the one portion, which is the portion for the survivor, and that will be the portion, say the husband dies first. That's rather common. The husband dies first. First, we have to divide up the estate into two, because part of it's the wife's, part of it's the husband's. She's still alive, that's her portion. She can do whatever she wants with that. His portion, we take $600,000 of that, we put it into a bypass trust. It's a special trust just held for the purpose of designating that for the beneficiaries, which are the children typically. So say 3 children. So $600,000, $200,000, $200,000, $200,000. But what we do is we don't want to make that distribution immediately because the wife is still alive. So we want to defer that distribution. But we want to take advantage of that estate tax exclusion of $600,000. So what we do is we put it into that special bypass trust. And it sits in there until the death of the second spouse to die, which is the wife. And she may live another 10, 20 years. So during that time, she can live off the income. She can access principal up to 5%, or she can take out the income out of the trust. It's a special power she has. We call it the 5-on-5 power. So she can live off the income. She can take part of the principal, but we have frozen that part of the estate. All the appreciation, hence, will not be taxed any further. That portion will go now to the beneficiaries, which are the children. So we locked in $600,000 or now $650,000 or eventually $1 million into that trust, plus all the appreciation. And if we have a large disparity in ages between a husband and wife, so much more the appreciation is possible. Now we're assuming there's a large enough estate where there's enough assets for the wife to live comfortably on her half of the estate and the income portion of that estate, of the bypass trust. So what we've done now is effectively we've taken that $600,000 or $650,000 exemption and taken that exemption portion and frozen it and benefited from it now. Because had we designated that entire trust portion, that half, the husband's half, all to the wife, and if she were just a few years younger, she may die a few years later, you're going to limit your exemption now to only one time $600,000. Because there's only one exemption per person. So what we've done is we've doubled our marital exclusions. Between spouses, there's an unlimited marital deduction, so you can designate assets from husband to wife or wife to husband with no tax consequence. But it's that second to die that triggers the tax. So the time that we don't need an AB trust would be very small estates. If the combined estate is under $600,000, okay. And if it's not going to grow beyond that, we're okay. If the combined estate is over $1 million, say $1.5 million, now we should be thinking about an AB trust situation because we can double that exemption and pay zero estate tax. And this is, again, a penalty for poor planning because this trust is not difficult to create. It's a lengthy document, but very standardized now. Attorneys are very familiar with it. So we do that. We've covered an estate value now of maybe up to $2 million under the new exemptions as they're phased in. And we get all the life insurance proceeds out. Say that's another $1 million. We're up to $3 million now with no estate tax. Well, let's go one step further. Say we really want to maximize our estate further in the future, and we're looking at estates now of what, 3, 4, 5, 6 million. People have their stock market portfolios have escalated in value. We have now real estate values are going up. Everything's going up. We're in a booming economy. People now see their wealth growing. We had one client in our office. He started 10 years ago with $1 million, and he put it all into he used Charles Schwab as a custodian. He put it all into equity stocks. That's all he traded, just equity stocks, no dividends and no bonds. And he built that up into $10 million now, and that took him 10 years, just trading equities. Now, of course, he picked the best time in his life to do that, a rising market, but it's just amazing the exponential returns and the returns that people have had. Now, he came in for estate planning. He did an interesting approach because he did not want to tell his children that they were going to inherit $10 million. And that's $10 million today. He's still in his 50s. That could end up being 20, 30 million by the time he's let that even grow further. But his choice was not to let them know because his children are in their 20s. One's studying to be a doctor, one's studying to be a lawyer, one's studying engineering. And he figures, hey, if they're each going to get $5 million, if they know that today, they're going to drop out of school, right? They're going to go, what do I need to study for? I'm going to be rich anyway. I am rich right now, my gosh. I'm just going to, they're going to become what? Playboy, they're going to become, go travel, have fun, sports, excitement, but not, hard study, not hard work. So he purposely kept them unaware of this trust fund on their behalf. And that worked beautifully, because now these are educated students that are going to proceed with their families, and then at an appropriate time they get knowledge of this large trust fund for their benefit. But this is why we have to consider the fact that estates are growing so large. 10, 20 years ago, somebody's a millionaire, sounds impressive. Today, average estate today in that size and range. So this gentleman with $10 million now, a living trust is appropriate, but what are we going to do now? We're way above these exemptions. $2 million, we're up to $10 million now. What are we going to do? We're going to have to pay estate tax up to 55%? Well, let's think again. Penalty for poor planning. Well, let's look at more planning opportunities. The gentleman engineer, he was what, in his 50s, life expectancy, probably in his 80s. We've got 30 years of planning ahead of us. Very long time to do planning. So what do we want to do? We want to gift that money to the next generation, but still have control of it, because the problem we run into with gifting is we don't want to break up such a sizable chunk of money because he can manage it so well when it is $10 million. You can do asset allocation, you can minimize risk, you can buy portfolios, you can buy large chunks of stocks and do very good with management with large amounts of money. When you break it into small amounts of money, people tend to buy treasury bills. They tend to buy Series E bonds. The ones you get when your grandfather, Christmas time, he gives you those Series E bonds. They look like they're, what, $100? He buys them for $30. What are they going to earn? 4%. So you have $10,000 here, $10,000 there, earning 4 or 5%. Well, that's really not a good method of minimizing risk and maximizing return. What we want to do is give these children gifts, but yet retain control. So what we do is we set up a limited partnership. And this limited partnership is exactly that. Limited partners, we designate the children. So each child will get a percentage. And let's take that $10 million. Well, why don't we give them each just perhaps 1% or less than 1% of that estate? We want to give them the magic number of $20,000 per year per child. So we gift to them $20,000 per year per child. That's $60,000. All the future appreciation goes with that gift. But do we give them a physical, tangible gift of that money? No, because we're afraid of what they're going to do with it. They're going to take that money, spend it again, right? We don't want that. Or they're going to put it in an investment account not earning the proper yield. So we keep it within this limited partnership structure, and what we do is we designate to them that they own a portion of that. They own 1% of that limited partnership. So we have a limited partnership, each child 1%, 1%, 1%, 97% to husband and wife living trust. So we take 1%, 1%, 1%. 20,000, 20,000, 20,000. Completely tax-free transfers, but we still have control because the portion that goes to the children is still physically within that large account. It's never been diluted. It's really still intact. What we've given them is intangible paper. We've given them a notation that they're a 1% member in this limited partnership. So what can the child do with it? Say they are 21 years old and they do want to spend the money. Well, they can't. They can't sell it. Nobody wants to buy a 1% partnership interest in a family partnership comprised of parents that are not cooperative. You can't encumber it. You can't go to the bank. Nobody's going to lend you on it. You can't demand any distributions because it's still in the partnership. What you do, you're owning it, but you have no control. So what I call it is have your cake and eat it too. You've been able to gift this to children and yet keep complete control. I call it strings attached. You're giving it away, but you're keeping enough strings attached to do what you want to do with the asset. So you can invest it, you can protect it. Children go through marriages, lawsuits, divorces, all types of things, business breakups. They could lose that asset. They could put it into the wrong structure. So keep it within our structure and just give them paper, intangible ownership. Now, if we do this every year, say we go 1%. Remember, we had a gentleman in his 50s. He's going to live to be in his 80s, so we have 30 years. 30 plus 30 plus 30 equals 90%. We can dissipate and transfer to the next generation 90% of his estate, but have complete control. And remember, we're dealing with significant wealth. We're dealing with more wealth than people can spend in their lifetime. And even if you were to spend it, what are you going to spend it on? You're going to spend it on tangible assets. You're going to spend it on real estate,